welcome back, everybody. Please have a seat after lunch. Glad you came back. Nice to see everyone didn't run off. Well, this afternoon we're going to get through the Part B of our presentations, but right now we're going to be dazzling you with information about forms. Obviously, we're the government, and as you might expect, we got a form or two that you might want to take a look at. As a matter of fact, we've just undertaken a fairly significant review of all of the forms that are being used in the HUD 242 program. And one of the subject matter experts on this is J.B. Nathan, and he was kind enough to volunteer to come on up and give us a walkthrough on some of the significant changes that have happened with a lot of the forms that we use. Now, new lenders, there's a lot of forms. I'm not going to kid you, and there's a lot of information that go into these, but JB's pretty good at being able to walk us through these in a pretty straightforward way. So I think on the first pass, you're going to see a lot of information that makes sense. Some might require a little bit more work, but JB, please walk us through some of the information on the forms. Thanks for doing this for us.
Okay. First of all, I want to answer a couple of your questions that I know you're just dying to ask and things like that. And the first one is do we have a fillable 92013? And the answer to that one is I sent out an email. We've had it in the works. I sent out an email on Monday on it. And at this point, it is not ready, but I'm told that it's going to be fairly imminent. But unfortunately, right now, it's not there. I also want to point out for you on the applicant's guide, if you just go to the I always go to FHA.gov, and then I choose the Hospital 242 program. And if you go down there and you choose the resources and click on the handbook, you get one that doesn't have all the bookmarks on it. But if you choose Getting Started on a deal, when you go in there, the first page on that has a link to the pre-applicant's guide, and then you go to the second page, it's got the applicant's guide there. If you click on that one, it's got a version with all the bookmarks in it. So if I were downloading one to my computer, well, that's the one I would take. So I just want to tell you about that little trick in there. The third thing I want to do is I want to thank you. We've done a lot of work here on this handbook and on the new 2013, which I'm going to go over here in just a minute. And quite frankly, you as the lenders and the Healthcare Finance Committee has put in a lot of input in that. So I want to thank you for your help in this, because quite frankly, we wouldn't be where we are today if it wasn't for your help. This stuff has been in the work for over 2 years. And going with 2013, at the end we're going to come to the 2264, which is a HUD form, which we've made available to you. But you're going to really like that because it runs through a lot of automatic checks. So if there's a problem in it, it identifies it up front. So you'll know where the problem is before you even send it to us. So you can fix it before in there. So with that, let's go into the 2013. So next slide here. We're not going to get to the next slide. I've got down here slide number 90 is just a picture of the new 2013, and what I really want to do is I want to go over on the form here some of the new things that are changed. So I'm not going to go over the stuff that's been there all along, but I want to go over the stuff that is new in there. So right now I think, here we got the form. So this is the new 2013 in here. And let's just go ahead and we'll go to the next slide in here. We're going to talk about some of the new fields that are on the form in here. And first of all, this form's been posted since for over a year. I want to say last summer in July is when it was first posted. This is an updated version of it, but a lot of this stuff has been out there for some time for you in there. It was modified for the 241 requirement, so there's a detailed instructions. It used to be the instructions for the 2013 fit on one page. Actually, there's a half of 2 pages in here. but it fit on one page. Now it's like 28 pages. But you say, well, is this all changes? I'm like, you've just implemented all sorts of, it's all been there buried in policies and handbooks and stuff before. And what we've really done is just taken this stuff and put it together in one place so that you have it all in one place for you in there, so that there's no hidden secrets in there. So you should like that. Under 241, there is no requirement for hard costs or equipment. That's going to be a big change you're going to see in there. Typically, it would be equipment, but we kind of had an internal debate and we said, wait a minute, if you're actually purchasing property with the 241, you could actually have no hard costs. Now, I will point out on a 241 in here, this might be a case, if it's only equipment, this might be a case where you don't do a 25-year note, because guess what? The life of the equipment's not 25 years. So this would be a case where you might use a shorter period in there. 223F is now built in there in the new version. Swap termination costs, that have been included in it as well. You also notice over here I highlighted, they went a little bit too fast for me, I wanted to point out that everything is in whole dollars in here. So don't give us a 2013 that says 36 cents on it. We're just dealing with even dollar amounts in here. And when the mortgage amount, that has to be in multiples of $100 in here. Sometimes that comes up as a question. And then finally, what happens when I'm calculating my fees and percentages and stuff in there? What we're doing is we're rounding down to the nearest whole dollar throughout the entire form. Okay, next slide. Okay, so let's take a look at the top section of the 2013 here, and what are some of the changes in there. First of all, we pointed out it's the mortgagor's, the borrower's legal name goes on the top line. A lot of times there's been confusion on that. We tried to address that issue. Then section A2, the 2 is the mortgagee, that's you in there. We also added a line over here for the date prepared in here. As you know, during the application process, first of all, for the pre-app, you give us a draft 2013, and then you submit the application, and there's a 2013. Then you get the GMP, and guess what? There's another one. And then we're ready to issue the commitment, and you've gotten the GMP, and costs have changed, and you're shifting things around, and there's another one. And then between the commitment and the actual endorsement date, guess what? You went out and you had the note sale or whatever, and you got the actual real pricing, and so you come back and guess what? We got another one in here. So to keep all these straight, we actually put a place right here to say the date prepared, so when you're looking at the 2013, you know whether you're looking at the last one in here. Section of the act. You used to have one little space in here to try and squeeze it in, so we've kind of added more room in there. So tell us right there, it's a 242 or it's a 241 pursuant to 242 or a 223F. So in here, and that makes a difference on the MIP and the fees. So we're asking for that information right there with respect to that. The type of entity in here, if it's a not-for-profit or a for-profit or a governmental, that affects some of the what can be included, for example, AMPO or not AMPO, and so we ask for that space right in here. And then the funding source, that's a new box right here for the funding source, and that basically what we're getting at there is there going to be related bonds, in here? Are you just issuing them alone straight? Is it going to be Ginnie Mae's? Because again, that affects the fees in there that you can charge. So we need to know we're asking you up front on day one. Now, if you don't know what it is, at that point, just say it's to be determined, put a TPD there. But in that case, we're going to assume that bonds are not involved. So the fee is going to be limited by that one there. And then we've asked over here for the calendar days in the construction period. That's used to determine the amount of mortgage that can be capitalized and stuff like that. So we're asking for that right there. Let's go to the next slide. In here, new construction versus rehab. This has been a question that's come up several times in here. New construction is basically on building a building on empty ground in here. Rehab is I'm knocking out the walls and I'm refurbishing it in here. So that's basically what we're getting at on that one there. If it's only refinancing with no hard costs, let's say I'm doing a 223F or a 223A7, so basically if line C11 is 0, then just put in, you can just ignore the box in there. Not-for-profits, and why is this used? It's used to help determine the amount of contingency that's allowed. That's the net effect of it in the end. Not-for-profit versus for-profits, that affects the AMPO in there, and so that's why we've asked for that. And the source of funding, I've really already talked about that in there. So let's go ahead and go to the next slide. The calendar days in here, we've already said that where's that going to be used for? That's going to be used for, one, to determine the commencement of amortization date, because you're allowed to include in the, I'm going to say when the commencement of amortization, we just assume the construction period takes the full time, and you're allowed up to 2 months after that, 60 days after that. So basically, the commencement of amortization date is going to be determined by the days in the construction contract. Now, when you first submit your application, you may not know those number of days, because until you've got the GMP, you may not have it. So you're just going to be guessing or estimating or something like that, in which case you're going to write in the box EST next to it. It's an estimate. You know, that's all you can do. But prior to issuing the commitment, you're going to have a GMP. There's going to be a construction contract. It's going to have a period on it. Okay? In that case, then you can fill in that date, and that's going to determine everything else that flows after that. But it does then affect the commencement of amortization. It affects the MIP that's allowable inside the mortgage, because that's up to 60 days past in there, and it's going to affect the capitalized interest. And you say, well, what's the basic formula that we use then to determine the construction period in here? And what we do is we just assume every month is 30 days. Isn't that nice? You know? So basically, we're going to take the number of days in the construction contract. We're going to divide that by 30. If it comes out to be 27 and 0.65 or whatever, we're just going to round it up. So we're going to make it 28. So we always round that up, because you never know whether it's going to finish at the beginning or the end. And then we add 2 months. And that's your construction period. That's going to determine what the commencement of amortization date is. So it really becomes very objective, and you know exactly what it is. Actually, with our automated 2264, it will calculate that. So if you've got a period there that doesn't match that one, there will be a discussion. Next slide. One of the other things you'll notice in here, it used to be that we had like field 1, or field 1 was construction, field 2, and it had like all these other lines in it, and it was all field 2. And, you know, so we talked about 2A, 2B, or 6A, 6B, 6C. We just gave every line its own number. Let's solve the problem. Let's make it easy in here. You're going to find some new fields. Every deal has contingency if you got construction, and we didn't have a line item there for contingency in there. We thought maybe contingency should be there. On the other hand, what was there was demolition costs, and hardly any deal that I have has it. A lot of times if there is demolition, it's built in the construction contract itself. So we just said we'll take demolition and put that under other, if where it applies in there, and that's detailed out in your applications. We also added total hard costs and total soft costs. You saw in the regs that it talked about some things are related to the total hard cost, to the total mortgage, and things like that. And there's been confusion as well. What is hard costs? Well, now you have a line on here that says total hard costs, line 11. It's everything above that. So, you know, and what's the soft cost? You got over here total soft costs in here, line 28. And so consequently, there's no question in here. It's pretty black and white. There's a new line for special tax assessments. We'll talk about that a little bit. Land and PP&E to be purchased. Questions have come up. What happens if the hospital is purchasing property? Where does it go? Guess what? If you're acquiring or if you're actually purchasing land or you're purchasing the building across the street as part of the deal, it goes over here on line 31. So again, we've kind of put the spaces there. It was implied before. Those questions are now kind of put to bed. Where does it go? We've renamed some sections: legal orgs, consultant, AMPO, and special assessments. We basically took AMPO out of the financing cost because it's really not a financing cost. It's an allowance of other costs, so we just kind of put it where it belonged on that one there. And then section D has been renamed estimated cash requirements, sources, and uses. That really has been, so that whole section really got rewritten to become a true sources and uses in there with regard to that. So let's go to the next slide. So let's take a look at C10 in here. C10 is your total hard costs under 242, and total hard costs for a 242 must be greater than or equal to 20% of the loan amount. So basically we're looking at the total hard cost line, we're looking at the mortgage amount, and the answer is it's got to be greater than 20% or greater with regard to that. And equipment must be less than, this slide was supposed to be changed. Equipment must be less than or equal to total hard costs. No, equipment must be less than or equal to 50% of total hard costs in there. So, So that one should be 50%. We'll get a corrected slide, I presume, and get it posted or version or whatever in here. Section 223F, total hard costs must be less than 20% of the loan in there. In fact, they could be zero, but they have to be less than 20% of the loan. There is no rule on equipment, so on a 223F, it could be all equipment or it could be no equipment or whatever. So the 50% rule for equipment doesn't apply on a 223F. On a 223A7 and 241, on 241, there's no requirement for equipment in there. Probably there's hard costs. If you were actually purchasing a property, that's a case where you could have no hard costs because the purchase would go over on the other section that we talked about earlier in there. But typically you are going to have hard costs on a 241, but it could be all of it, it could be less, it could be, whatever in there. On a 223A7, the only hard costs you're going to have there are going to be required repairs. So you're going to have to justify in your application why this is a needed repair. It's not we want to do it, it has to be required in there. And then this stuff here, these tests here are all included in the 2264-0 we'll get to, and it actually tests for whether or not these requirements are met. Let's go ahead and go to the next slide. Interest. All I can say on the interest, there was a lot. If you looked at the old handbook requirement, it basically said if it's a rehab project, you need to include 2/3 of the loan amount for Cap I. If it's a startup, basically construction, then it's 50% coming in there. And there's a big difference of how much Cap I you need if 80% of the loan is refi versus if none of the loan is refi in here and stuff like that. And how long's the construction period and how does it go? How much is equipment versus how much is the construction in there? So there was all sorts of factors. So what we basically did with your input is we came through and rewrote this section with a very complicated formula which is written out in detail in the handbook. But basically what it gets down to is what's the initial draw going to be? And based on the initial draw, it says, guess what? On the initial draw, you're going to have to pay interest starting on day one, and it assumes that the rest of it is kind of drawn out equally over the construction period. That's the JB simple English version of the formula in there. The number of months for that construction period we already talked about, that's already predetermined based on what's written in the construction contract, plus 2 months. And the 2264 will check, you you put down what you think they're going to need in here, and I know you have the actual draw schedule, so you've got information that we don't have when we're doing the underwriting in here. Our form's going to check for plus or minus 5% of the calculated amount. If the variance is greater than that, plus or minus 5%, the AE is going, which is the account executive or the underwriting team, is going to be told to go and talk with the underwriting director. And so basically, we can override that amount very easily. It doesn't require a handbook waiver to change it, but there's going to have to be an explanation given to the underwriting team, and the director, you can figure, is going to be asking, why is it off of that amount? And, so just know that that question's going to come up. C13 is for taxes. So when we come down here and we look at this taxes and insurance on C13 and C14, that's for taxes on the property that's being constructed during the construction period in here. Or it could be for bond insurance if the bond insurance is being paid by the hospital rather than by the contractor, which is usually not the case in here. But in those cases, that's a case where you'd have that. Usually, I want to say 90% of the time, those lines are just left blank. They're zero because they just plain don't apply in there. C14, oh, and we already talked about C14, so we're good. Let's go to the next slide. I'm going to try and keep us moving here. The mortgage interest premium in here. We've got, for a 223A7, it's 55 basis points, but for the first year, it's 50 basis points. We already talked about that earlier on the fees. For the 223F and 241, it's 65 basis points, and for 24270, it's 70 basis points is what's includable in the insurance in here. Now, from what I said earlier, I know there's going to be discussions about the 100 basis point factor in here, so I'm just going to say that's up in the air, okay? But right now, this is the way it goes in here. For underwriting purposes, in here, most of our hospitals at the end of the construction period, after they go to final endorsement, and then there's an audit of the actual MIP fee, most deals they're getting money back. So I don't know that there's a need to change what actually goes in here for underwriting purposes at this point in here. But that's just the matter of the facts that there's, but the form does calculate the MIP, meaning the 2264, okay, in there. And obviously, if the calculated amount is different, then if you've got a number in there that's different than the calculated amount, it will require at this point, a handbook waiver, and the form's locked, so the AE cannot override that amount. That's the amount of the fee, because it automatically calculates the fee. Andre?
Is it calculated based on months?
Yes, on the construction period.
But HUD, on a regulatory basis, HUD collects based on a full year. If you only have a partial year, HUD is still collecting or requiring a full year.
Correct.
Of MIP.
But when they go to final endorsement, well, let me repeat this here because we got people in the netherworld that won't have heard your question. What Mr. Andre's question was, well, what happens if there's a partial year, because construction projects never end on the year. So there's always a partial year in here. And what happens is you have to pay the fee 1 full year in advance in there. All right, but when you go to cost certification at the end of the project, all that's allowed to be included in the mortgage is up to 60 days past the substantial completion date. So what happens then is that's all that's allowed to be included in the mortgage in there. And that's in the cost certification guides in here. So what happens is we've now clarified that all you can draw from the mortgage amount, so let's say it's a 3.5 year construction period, okay? You could only put then 3.5 years plus 2 months in the insurance, and during the final year of the mortgage, you would have to collect for the remaining 4 months so that you would have that money. Actually, you have to collect it during the second year because you have to pay the full year at the beginning of the third year. So, has that answered your question?
I disagree with your response and your analysis, but I accept it as an answer.
All right.
So this would be a big change because we're going from loan sizing to call certification in the 2013. No hospital has ever got to substantial completion within 60 days of its scheduled completion date or initial completion date, or anyway, I don't think anybody can name 3. So in reality, they could collect, or they could draw more MIP than what you're allowing them to capitalize in the loan. Because if the construction period goes long, they can continue to draw MIP even beyond the 60-day period, beyond the scheduled substantial completion, because the rule is 60 days beyond actual substantial completion.
Well, actually, we have a GMP with a contract
Correct.
date, which is a fixed contract date,
Right.
and then if they don't complete it by that date, there's liquidated damages.
Well,
So-
that's actually, but the date is always, as your OAE guys will tell you, was constantly extended through change orders, and then that still doesn't mean you actually get to substantial completion. So what do they do if they've drawn out, you get to the final year, and they've only got 3 or 4 months in the loan budget, but they need to draw out, or they have the ability to draw because they haven't gotten substantial completion? Are you guys going to automatically allow them to draw out an AMPO for the full year, the MIP? Or are
Actually-
you going to make them start escrow? This would be the only HUD program that you're going to have to start escrowing for MIP early in the construction period.
Actually, that is one of the stated potential uses of MIP, of AMPO.
Right, but
So AMPO, yes. So the
you're
answer
going to let them
is,
draw out the full year? So
No,
they
they'll
can
only
do
be
a
able
full
to-
year payment?
they'll only be able to draw out, MIP may only be included up to 60 days past the substantial completion date. That's a
Right.
fixed date, it's determined at the time. So if there's a
But you don't
contract
know-
extension, if there's a contract extension from, I want to say June to July, because they need an extra 30 days to complete this because of something in here, then the answer is, could they use AMPO to cover that 30 days for the MIP? At that point, that's one of the potential uses of AMPO.
Right, but you don't know that at the time that you have to put this 2013 in and the loan's approved, and you won't know that until you get to the MIP payment date, which is 2 or 3 years.
Well, we won't even
out.
know that on the MIP payment date, because
Right.
on the MIP payment date, they got paid back on January 1.
Right, but you're making us assume in loan sizing that everything's going to happen on time, and the cost certification rules as written are going to work, assuming no delays. That's never happened in this program.
In underwriting and what can go in there, we have to assume that the commencement of amortization date, let's put it from the banker's perspective.
Yeah.
You don't care whether there was a long delay, guess what? When the commencement of amortization date hits, they got to start making the
Well, that's because you guys require
mortgage
it.
payment. So I'm saying that's just the way it is.
Well, no, it's not. The way it is that you draw out MIP each year that
Yeah.
you have to pay it out of the budget
Yeah.
until, and you've capitalized 1 year for each year of construction. That's the way it's
Yeah.
always worked until today. And then when you run out of that money, then you
Yeah.
can go to other line items to transfer it in if you're still going through construction, or when you get to the actual substantial completion, and then you do your cost cert, then HUD determines all the non-allowable costs, disallowable costs, and other allowable costs, and kind of balances out, and then figures it. You're prohibiting that process to happen on the back end by this rule.
No, we're not prohibiting it, because that's what AMPO is for. But I don't know that I agree that all projects have significant extensions of time on the construction. In here, I think there's a certain amount because of rain days that are kind of built in there that's normal, but in terms of significant things going beyond the substantial completion date, I don't know that happens regularly on the actual construction. It does happen on final endorsement, I will agree. And I don't see Teresa shaking her head at me, so with regard to that. All right, so your costs are only allowed for up to the substantial completion date plus the 60 days in there. The 2264, like I say, does calculate that in there. There's no cap I, which is capitalized interest. taxes, insurance, or mortgage and premium in Section C if it's insured upon completion. Because guess what? You don't have insurance on advances then. Okay? And since it's 60 days past the substantial completion date, if you don't have a substantial completion date, then basically it all goes over in Section D in there. And it will go on line D5 or D6 in there because these just plain don't apply. All right, let's go to the next slide. A lot of times we've had questions because we talk about the application fee and we talk about the exam fee, and there's been questions, well, if you look at, and there's the commitment fee, and there's been questions, well, how do these relate? Well, the application fee and the commitment fee equal the exam fee. And so we've just kind of specified that out for you. The application fee of 15 basis points is due with the application. We don't have, as far as we're concerned, we don't have an application if we don't have a check in here. The commitment fee of 15 basis points is due within 30 days of the issuance of the commitment, and the reg says if we don't have that fee, the commitment expires, and then you can be subject to a reopening fee. You don't want that to happen, so the answer is you're going to make sure that you get the check to HUD. So don't wait until initial endorsement to pay the commitment fee. It needs to be paid within 30 days of the commitment in here. The inspection fee in here, and I've given the citation on that, that's based on the total hard costs, which is line C11 in here, and it's a variable rate depending on the ratio of the hard costs to the loan amount. And remember, you calculate the percentage, you find out where it goes, and then it's going to be rounded down to the nearest dollar. The 2264 calculates that automatically for you, but here's the basis points for that. In the handbook, you have the actual, I believe, mathematical calculations and formulas. Let's go to the next slide. Permanent financing fee. Now you'll see in here we have the permanent financing fee and the initial service charge, which matches the regulations, so there's no question. There was a lot of confusion which one was which, and and lenders were mixing them up. So we've made the form match the regulations, so there shouldn't be any question, just to get rid of confusion. Because you determine those fees, we've left a blank here. You can just put down what percent you charged in there. With regard to that. Now, as we stated earlier, there are some caps. That's what the handbook and the reg do, is they put caps on the amount of the fee that you can charge. So it's limited to 1.5% for the permanent financing fee, or 3.5% if there's bonds. Remember, and you check that box up above, you told us that up there. There's special rules if mixed financing. There's an example in the instructions that goes through a mixed financing example for you. So if that actually is the case, you can take a look at it. Our form will not do the mixed financing thing, meaning that we're going to have to make our own manual calculation to verify on that one there. The initial service charge is limited to 2%, but in the case of A7, remember the combination of the 2 and the 1.5 or 3 is limited to 1.5 or 3.5%, as the case may be. So let's go to the next slide. Special tax assessment. This is JB's definition for legalese purposes. So don't hold this to be an illegal thing here. This is just, let's try and put it in simple language. A special tax assessment is like when the city comes in and they put in curbs, or they put in sewer lines or new water lines, and they come through and it's basically a property improvement to the improved land. And remember, HUD insures based on the improved land site. So then what they do is they send you, the taxpayer, a notice, and they say, guess what, you're responsible for X number of linear feet of this, and so your bill is this. Now we're going to go out and sell bonds on this, and the issue is you can either pay us your share now, or we'll sell bonds on it, and you can pay us over the next 10 years. So basically what it amounts to is a borrowing for the land improvement. And guess what? It's all due at initial endorsement because we require a first on everything, the same as if they had a loan out on the house before. So that's really what's going on there. AMPO, it's up to 2% in there. It only applies for nonprofit or governmental, so if it's a for-profit, that line is 0. It's up to 2%. Furthermore, some hospitals or nonprofits, they'll say, look, we don't want to put any AMPO in there, but yeah, we recognize we're going to have some, AMPO is allowance to make project operational. I should explain that. That's what it stands for. They say, because oftentimes at the end of the day, you got move-in expenses, you got other costs in here that come up in the end. We ran across the case, what happens if it ran longer and we had the additional MIP there? But something's coming up there, so what do I do on this one here? For underwriting purposes, we're saying we want to know that you got enough money to get to completion. The hospital could say we'd rather post additional working capital. Additional working capital is money that the hospital posts outside the loan, okay, over in Section D, so that, and then they don't have to borrow the money for it. So if they don't want to borrow the money for it, they can post it as additional working capital. For-profits are still required to have that AMPO in quotes, but what they do is required to have additional working capital, and so we just don't allow them to use loan proceeds for it. In there, can I just post none? The answer is yeah, you can post none, but guess what? It's liable to become an underwriting question in here, and so you may have to post some to pass underwriting. Clarified that the savings clause applied. There was confusion about what happens in here with the AMPO at the end when we go to final endorsement if I got savings. Can I just use this money to buy other equipment? Do I get all this money back as cash at the end? And what happens is the handbook says it's not intended to cover items that could be paid from operations or additional change orders approved by the hospital without prior HUD authorization. So if the hospital just goes out and spends the money and says, oh, now we're just going to fold it into the loan, guess what? You're liable to find that the answer is no. The savings clause applies, which is in the covenants, it's in the reg, and it basically says we're going to take the savings at the end and it's going to be distributed pro rata in here. Sections C27 and 28, that's your total soft costs and your total legal org costs, so it's just section totals. Let's go to the next slide. So C29 here is our total estimated project cost. We redefined the lines here, meaning specified the language to eliminate confusion because you have estimated replacement cost and you have estimated project cost. So C29 got renamed to total estimated project cost. That's basically your total hard cost plus your total soft cost in here. So that's the cost of the project in here. And it's used to determine the amount of the inspection fee. So that inspection fee, that's the line that we go by. C30 to C31 is your existing land and PP&E to be included in the collateral in here. And so the hospital, for meeting their equity requirements and stuff, already has equity in the project. That's your net PP&E. There's actually a loan-to-value form. We've posted that on the web for you that we use. It's a HUD form. Okay, but quite frankly, you want to take a look at that form because it goes through line by line exactly how to calculate the net PP&E. So basically what we do is we start with the prior year audited financial statements. From those, we then subtract any carve-outs in here. We're also going to eliminate anything that's going to be, we had a case, for example, where a hospital was going to be blown up or sold at the end of it because they were building a replacement hospital. Guess what? If there's a significant write-down that's going to happen at the end of the project, we're going to take that off. And then we add the project costs onto it. There's a discount for leasehold interest. Okay, that's all spelled out on that form. It goes through step by step. We calculate it for our purposes, but that form's made available for you. That's the value, but you have to do that to fill in lines 30 and 31. Okay? In there. And we ask you, when you put in the amount for line 30 and line 31, for you to give us how you got at it. Now, you could use our form that we used in here, or you can just put it in your notes. I'm like, I would say just put it in your notes, but you ought to, but you've got the form in there. So, but I just include as a note to the 2013 in there. So I think I've answered these questions here. Make sure that the hospital, one of the things I told you about is make sure that the hospital has fee simple title and not a leasehold interest in the property. You don't want to find out when we're ready to get to initial endorsement that loan to value is calculated on having this property, and guess what? They really don't own it. They're leasing it, or they own 90% of it, but there's these pieces over here that really they have a leasehold interest in, with regard to that part there. Also, on the lease part of it, I will tell you that if the leasehold interest is we cannot take a leasehold interest that's less than 50 years. So it has to be 50 years. If it is 50 years, we're going to discount it 90% on the value in there. If it is for, I'm going to say 99 years, but we've worked out it could be 50 years with the other 49 years only comes into play if there's a claim. This is JB's simplified English in here. In that case, then the discount's only 5%. So what you really want to do is have a 99-year lease. Okay? In here, let's go on to the next section in here. So now we're looking at refinance capital debt. And one of the things I want to point out is all debt is not necessarily eligible to be included. It is only refinance capital debt. So if they have AR financing, if they got working capital loans, that's not going to be eligible to be refinanced here. Now, the definition of refinance capital debt, and I've taken this straight from the, I think it's in the revised reg in here, but the outstanding indebtedness used for the construction, rehabilitation, or acquisition of the physical property and equipment of a hospital, including those financing costs approved by HUD in there. So now it may include swap termination costs or a portion of the swap termination costs, because you're going to have to look at the qualifications for what's allowable on swap. It should be a note showing swap termination costs. So if you've got swap termination costs, you're going to have to attach a note to it in here with regard to that. And by the way, I think on the swap termination, it was for swaps entered into prior to, I want to say, 2008. So if it was after that, I think it's not going to be allowed in there. The swap termination cost, I could be wrong, it could be 2009, so I'm just saying, look at that note if you're dealing with that. Swap termination costs included on line D2 should be listed in the box to the left of section E. You'll see this in a picture, but basically in the lower left-hand corner of the form in here, there's a note, it's a little box carved out, it says for HUD use only, but there's a nice little empty blank box there. Okay? In that little blank box, that's where if there's swap termination costs that are included up here in the refinance capital debt, you're going to write down swap costs included in D5 in there. And so you'll use that little box for that. Ineligible swap termination costs. So now what happens if it's greater than the 5% or 10% limits, as the case may be, or something like that? Then that's going to go down on lines D5 or D6, this other funding requirements in here. That's where it's going to go down there, and you're going to put a note, or you're just going to, where it says identify, you're just going to write swap termination costs there, or MIP there, or whatever it is. A lot of times the two lines, it's only a couple things anyway, so you can easily just put it right there. You don't have to do a note behind. But that's where that's going to go. There's a new line for purchase price of property to be purchased. So you'll see here we got on line D3, purchase price of property to be purchased. Up above, you put down the value of that property. Now you're putting down the actual purchase price of it in here. And what happens is the reg says only 90% of the lower of the value or the purchase price may be included. So basically what's going to happen is the 2264, when I go through with my automated test, it's going to do a comparison between the value and the purchase price, and then say which one's the lower, and then it's going to say 90% of that. That's all that can be included in the mortgage in here. D5 and D6, that's your other funding requirements. That could be for your mortgage insurance premium, if we're talking about insurance upon completion. It could be for your additional working capital, if you're a for-profit or if you're a not-for-profit who chooses to go with the AWP route. It could be for a special HUD escrow, if we've asked for a special escrow in there. It could be to pay off a line of credit, because the line of credit's not eligible for refinancing. That's working capital. So it might be money that's needed to pay that off. It could be for disallowed swap termination costs, and who all knows what else. So it kind of depends on the facts and circumstances in there. Usually there's not a whole lot of stuff that goes in this one, to be honest. But every once in a while, one of these applies. Let's go to the next slide. Total uses of funds. So before we had sources of funds, now we got total uses of funds. Guess what? That was everything that we just did above. Don't ask me why I didn't get total uses on the previous slide. Okay? But now we've got the total sources. Where am I going to get the money from? And quite frankly, line 12, total estimated FHA cash requirements. If I really have better thoughts, I would rename that total sources of funds now. But that's the sources that go in there to make up the above. So first of all, we're going to subtract off the insured loan amount, which was the amount you listed way up on the front in here at the top in Section A. Guess what? It goes down here in Section 8. That's the amount of the insured loan. Less grants or approved loans. Maybe they're getting some of the money for this because in some cases we've had like a FHA, or I want to say an agricultural loan that was doing part of it with it. Maybe there's a state grant of funds that's coming in here. The handbook has always said, going back to our 1973 handbook, has said that gets excluded from the loan amount. So anyway, there's a line here for you to list that in there. List other FHA requirements. We've already talked about that. So this is those other requirements. Guess what? You've listed them up on D5. Now you're going to put it down here because you got to have cash for that. And then that gets to the cash equity. So when we're talking about have you met the equity requirements and stuff, how much equity you're putting in, that's your equity you're putting in there. And guess what? If you add all those up, you're going to have your total sources of funds. So that's what that one is. Let's go to the next slide. So Section E is we now have added a new section down at the bottom on your form. And I didn't manage to get a picture on that. I don't know how I didn't do that. But anyway, your info, this is where you put the info on the leased property. Because remember we said how much of that could be included or how much was the discount? You're now going to tell us, is there any leased property that you're included in this? And if so, how long is it? Because that goes into calculation of the loan to value. So you're putting that information right there on the front of the form in there. It's used in underwriting to reduce the Now there's another box there, E2, and that's your other non-FHA cash requirements. So let's say I'm using bonds. I got a bond sale out here, and the bonds are asking me to, or I'm going to have a letter of credit out here, and they're asking me to post so much money out here. Whatever it is, okay? If in order to get this deal to close, it's going to take part of the hospital's cash, and it's outside of the FHA deal, which we had up above, you're going to put that number down here, or your estimate of it in there. And you say, why do we need to know that? Well, we need to know that in underwriting because guess what? When we calculate what's the day's cash on hand, if the cash is over here, security for the bonds, guess what? It's not available for, for HUD. So that money's already been carved out. So basically, we need to know what that amount is for that one there. And then the HUD use space, we already we've got a spot in there to initial the date that we actually received it. Indicate that the amount, the application fee's been received, because we don't do anything without that. Check in here. And then the big blank amount you're going to use for swap. Otherwise, it's just plain not used. Okay, next slide. Okay, then we're finally now to page 2. And basically, page 2 is, we really haven't made any changes to that, other than a couple of extremely minor changes in here. But it needs to be completed and signed, because guess what? If it's not signed and dated, we don't have an application, okay, in here. So do make sure the total mortgage amount that you've got back here needs to match the total mortgage amount that was on the front. The permanent financing rate, that's going to match what you had up on the front. The term of the loan, it's usually 300 months because it's 25 years, but I gave you one case where if it's a 241 for equipment, it might not be in there. I know of a case where they had seismic concerns that came in there, and the hospital would not meet the seismic requirements after 20 years. So guess what? It was a 20-year loan, not a 25-year loan. The initial service fee charge and permanent financing fee, that should match what's on page 1. There is a statement for certificate of need down here at the bottom where you check off a box on that one there. So that's the changes on that one there. So let's go to the next slide. So loan to value. I told you have a copy of that. I believe you've got a copy of it in your packet here. But this here is the new form for calculating the loan to value. It's basically a HUD internal form, but we go through the entire loan in here. Basically, the AEs prepare their own, and they confirm the values that you have on the application. But guess what? We don't want surprises. We think under transparency, you ought to know what we're doing. You ought to know up front. And so guess what? We've made that available to you. So you can see it. If there's a problem, why should we even have to identify it? It's pretty straightforward. You enter the hospital name, you enter the mortgage amount up here on the top, you enter the project number, that goes over here. Then you're going to fill in the lines here as directed as you come down in here. You only fill in the appraisal lines here if there is an appraisal, otherwise leave them blank, or you're going to find out it does some calculations there, which you'll see right away, so then you'll back them out on there. That will go through lines 12 and 19. So lines 12 gets down here. On line 12 it says that's your existing land PP&E. That's the number that goes over on the 2013 for the existing land PP&E. The second part of the form down here is PP&E to be acquired. Okay? The last line on this one here is line 19. And guess what? That's the amount that should go over on the line that says plant, property, and equipment to be acquired in there with regard to that. Down here, it calculates the loan to value. You'll see that. And so you'll see what the loan to value is. So I'm like, it's pretty straightforward. All right, let's go to the next slide. The next slide is the new automated 2264. Now, we've posted a version on the website for you. When you bring it up, it's going to say lender's courtesy copy or something like that. Okay? Again, this is a courtesy for you in here, but it does several checks in here. And again, so if there's a problem on the 2013, if there's a problem in the loan to value, if there's a problem in the fees or the inspection fee being miscalculated, it brings up red flags and stuff like that. So you will see right away if there's a problem. We again think, as part of transparency, you ought to know that there's a problem before we even see it. Let's just get it right the first time. Does that make sense? In here. So I think you're going to really like it. You do have to fill it down in order. Because it consists of if-then statements going through there, if you fill the stuff out and then go back and say, well, no, this really isn't going to be a 242. It's really going to be a 223F or something like that. Then guess what? All the tests that it did for 223F, it didn't do. It did the ones for 241. So you have to go through and hit a thing on every field as you go down. So you have to do it in order for it to really work. It's locked, but wherever you see a white space on there, it can be changed. So they've brought up here the form on some of the other slides. You can see them over here. And wherever you see white space, you can go in and edit that in there with regard to it. So you're going to come down and it's going to fill it up in there. Let's go back to the previous slide on mine up here, okay? So The instructions, you've got the instructions. We posted that too. The instructions are detailed. They have the actual formulas that go with the calculation, so you can see exactly what we're doing. You'll also see over on the right of the form, it's got the code section, or for the line from the 2013, or you're going to see a code section or a handbook section that's going to be referenced, so you know exactly where it's testing when we get into the testing part of it. Column A is space for the AE comments. You could write your own notes there if you wanted to when you're doing it on your own. Column J gives the sources. We already talked about that. It's made to match the 2013. Basically, you just read the 2013 and go down from the top to the bottom, just kind of fill it out. There's one exception to that. I'll show you that in a minute. As we said, now do not submit this to HUD. So guess what? When you filled it out and you get finished, you keep it for your files. Don't send it to us electronically or any other way. We don't want to see your copy. Okay? In there. Bring the form back up here, and I want to show them where you see these green spaces. It says over here, you got a note, fill in green highlighted fields prior to entering capital interest. It needs all the fields. If you here you got a green one. If you slide on down on the form, you'll see it here. For example, again, to calculate the capitalized interest, I need to know the permanent financing fee. I need to know the initial service charge. I need to know the title and recording, because guess what? Those are all going to be part of the initial draw. So any field that is in green here has to be filled out before you enter the capitalized interest. Actually, it will calculate it, what the plus or minus 5% amount's going to be. At that point, it will calculate that field, and you can see what you've got, and then you can see if you've got a plus or minus variance of 5%. But it will let you override it, okay, with regard to that. So let's go to the next slide, which is on the, no, the next one is the back part, the actual 2264. So if you slid on down, bring up the 2264, Nick. Slide down to the bottom. Slide on down to the bottom. Okay. See, here's where it says mortgagee current. If you see down here, you got a tab. This is the data entry tab. This is where you enter the data in. Then if you go over to the 2264, okay, there, you actually have the actual form that gets created. Now, in your packets, I did see that you had a courtesy copy that I went through and did. So if you've got this one here, you want to bring up the courtesy copy that I filled out the numbers on? You don't have that one. Okay. In your packet, I think you saw one, but for example, now this tab M here this is basically where it's the rates that are being charged. That whole page is locked, but that's basically the rates. The 2264, let's go to this one here, this tab. All right, they didn't fill this one out. I had one that I was going to go through with you that was filled out, where basically we had a fail down here. And if you have a fail down here, then basically it's saying there's a problem. And over here you can see the criterions. You'll see what's going on in there. So, like I said, there's several flags on the front that will pop up if you've got something that's wrong. If you try and put in a rate that is over the amount, let's say a mortgagee, your initial service charge, and it's greater than the allowed amount, it just won't let you do it, okay, in there. There's other cases where it brings up a warning. If you go back to the data entry page here, on the data entry page, all right, right here, if you come down here, you've got I want to say up on the top, you put in at the very beginning, come on up higher, you put in the estimated mortgage amount. Right here, you got your estimated project cost. You can put it in right here on E11. When you get down to filling it out, it actually calculates what the real project cost is. If that project cost doesn't match the amount up on top, it will point up a big yellow box that says, guess what? There's a problem here. The numbers don't match. Okay? Start over. So, at that's all I've got on the 2013.
Thanks, JB. Okay, it's time for the pop quiz. You all ready? Excuse me. JB, thank you again. Oftentimes that form does cause people a lot of heartache when they see it. It's a difficult process to get through for those of you that have never used it before. Myself, JB, and others here are happy to help you work your way through your first efforts to try and understand all the data that goes there. So again, reach out to us anytime. For those of you online also, if you have questions at any point during today's conversations, hospitals@hud.gov is the mailbox where we're accepting questions for this afternoon's question and answer period, which comes up shortly. Again, that's hospitals with an S at hud.gov. Today, actually, we're going to now meet with Teresa Billick. She's with the Office of Architecture and Engineering. We've talked a lot about construction projects and refinancing and financing of various hospital projects, refinancing debt, but clearly one of the areas that I think HUD has some incredible expertise is in the area of construction management, architects, engineerings, inspections, review of plans. The group that we have within HUD that can help hospitals and lenders alike with their projects is just amazing. It's led by Teresa and her group, and I'm really proud to have her today. She came down from New York specifically to be with us. So, Teresa, I'd like to have you tell us a little bit more about HUD's role in construction projects and how we manage that risk.
Okay, thank you very much, Jeff, for inviting me here today. When Jeff and I got together to discuss what the training was going to be about, we were going to focus on the 223F program and the developments in the new handbook. Since there are so many of you who are totally unfamiliar with our office, the OAE office, Office of Architecture and Engineering, there's not enough time today to cover any of that, so I welcome you to contact us, and if you can't get what you need out of the handbook, then we'd be more than happy to talk to you about the program. Essentially, we're involved from the beginning of the application process all the way through the design and construction application process, and all the way through the closeout, and for 25 years after that. So we're pretty well involved. I think we covered pretty well this morning the construction costs plus the equipment plus all the other hard costs have to be less than 20% of the mortgage to have a 223F project. In many cases, the construction cost we know will be zero. One particular item of note is that minimum federal wage rates are not required for 223F projects. Nevertheless, the Office of Architecture and Engineering, as was stated earlier, has to make a site visit for every 223F project. And we do have to perform an environmental review as well. As was stated this morning, this is a new function for our office, and our staff has been trained to do the 4128s. How many of you are not familiar with the 4128 process? So that's good. You know what we're talking about. You're used to the protocol. Now, we were asked to go out and kick the tires, so to speak, for the 223F projects. But being that we're architects and engineers, we can't just go kick tires. We have a tendency to get involved in a little bit more than that. We like to define the scope of work for the proposed project. Now, you might think that's a very simple, elemental thing, but I can tell you that in our office, when we've had so many meetings, the owner's representative might have one idea of what the proposed project's going to be. The architect might have another. The mortgage banker might have a third. And this all comes at it sometimes at our meeting, and you know, the property that's included in the collateral could be completely different in their minds, and it isn't until they finally get to our office that they realize that they're talking about three different projects, so to speak. So we have to be quite exact in our office, and so it's very important that you figure out what the scope of the project is, and you know, everybody's opinion, because believe me, it can vary and it can change because you want to exclude certain properties from your collateral, and HUD has a tendency to put more properties in the collateral. So by the time you get to our office, we certainly would appreciate knowing exactly what the project's going to entail, because we have to look at it environmentally, and if you don't give us all of the information when we need it, we might even have to come back and make a second trip, and we don't want to do that. What is the total dollar value of the proposed work? what are the what I did was I developed a checklist as a crutch for our staff to use when they go out. Well, what happened was they liked it so much they want to use it on all of our 242 projects to write their site visit report. And what I'm doing and what I'm giving you an inclination of is what we're going to be asking for. We don't intend to incur the hospital extra costs, but we have to have a certain level of comfort in our projects. We have to recommend to the account executives on Jeff's staff and Paul's staff that we are comfortable with making a recommendation of approval. So the more comfortable we feel, we can make Jeff feel comfortable, and then he can go forward with the project. So we take it one step at a time. What are the ages of the existing structures? Has the facility endured any unusual events since the original construction? We've been having lots of hurricanes, tornadoes, etc. Has it damaged the hospital, or is there anything we need to know about that? Was the existing hospital of some certain poor construction? But don't forget, we're architects and engineers. We're into this. We should know the quality of maintenance of the existing structures. And when was the last phase 1 environmental study completed? Was there ever a good capital expenditure plan for maintenance and repair over the last 5 years, the next 5 years? Every project is different. Every hospital goes about business a little bit different from the other one, so we can't apply rules across the board. So we need to get into the details. Is there a facility master plan? Some facilities do a master plan that's rather elaborate. Some don't get that involved. But, if there is one, we should discuss it. We should discuss what the current project plans for and what their plans are beyond that point. We're going to check the condition of the roof because, the building structures to some people is not a very glamorous topic of conversation. They'd rather just, work on medical advances, or they're more worried about politics or competition in the marketplace. But if your roof is leaking over your surgical suite, you got yourself a problem. A lot of people don't feel that the roof is a glamorous item, but it can be a significant cost factor for a hospital. So number 10 here on slide 112, what are the different structural systems, mechanical systems, electrical systems, plumbing? It's not glamorous to mortgage bankers, but to the people who live there every day and have to work in there, it's quite important. We need to know the status of the warranties on major pieces of mechanical equipment, et cetera. And while we only have a certain amount of time when we go out to make our inspection, this sounds like we're going to get, in-depth studies here, and we're going to spend weeks with you. We're not. We're just going to spend a few hours with you. But if you know what's in the back of our minds with your projects when we go out, you can address the items, and then we'll be comfortable. Is the hospital focusing on work that is of a critical nature, or are they just focusing on one piece of expansion when the rest of the building is falling apart? Do they really set their priorities straight? Well, we can't exactly tell the hospitals what to do. In the end, it's ultimately their decision. Did they go about setting up their projects properly, or should they have considered something else perhaps? The best time to design a hospital is before you start construction. And it's really not good to change your design when you're in the middle of construction or add scope to it. And yet we see that from time to time, and that's not the wisest thing. It's often more expensive, especially if you have to rip something out that you originally designed for some other purpose. What is the status of the functionality of the existing spaces considering future needs? Is the building obsolescent? Categorize the proposed work. Do we have life safety issues? Are most of the problems programmatic? Do they entail fixed equipment? Or is the mechanical plant falling apart, or is it a combination of everything else? Next slide. Is the cost estimate reasonable? How was it developed? A lot of times contractors give owners estimates that they lowball, and then when it comes time to get the GMP, we find out that the price goes up $3 million, and then the hospital says, I don't know where I'm going to get the money for this. So it's very important to get a really good cost estimate. And how will the work be executed? Are there proposed contracts? Does the hospital have adequate staff to oversee the work? We require an owner's representative on all of our projects, whether they're from somebody on the facility staff or whether they go out and they hire a separate owner's representative consultant. What's the schedule of work planned? Will there be phasing necessary? Will patient care be interrupted? All of these things we have to think about. And of course, number 18, this is our big chance for energy conservation measures, sustainability, and green design. Have these things been considered? And why not? Have the hospital visited other sites where the latest technical advances have been made that maybe they could incorporate into their hospital? Has the hospital really put forth enough effort in this proposed project, or could they do better? What are the conditions of the exterior of the structure? Is the hospital aesthetically pleasing? Does it draw people to it? Is it accessible? Would the project be better off considering a 242 project? We talked a little bit about that this morning. Here you're coming in for a smaller refinancing project, but really, should this be a 242 project perhaps? Is the work, on the other hand, is the proposed work in the 223F, what I'm talking about is the proposed construction work really necessary in the 223F project, or maybe you shouldn't bother with it. You know, you have to think about this when you're first dealing with developing an application. And we will get involved with you early on if we can, if you want us to. Perhaps when we walk around, we might see some work that should be added into in addition to what, you know, might have to be considered. Hospital might completely forget maybe they need an additional emergency generator, or they need redundancy in a boiler that they didn't anticipate, so maybe the costs would go up. We use the latest standards. You know, what standards is the hospital using to develop their design? Is it an old standard, or perhaps they should use a later code? We use the latest codes in our office. Are there any Joint Commission on Accreditation deficiencies or deficiencies from the local building authorities that need to be resolved? And if this is the case, has this been considered in the work? Do we have double-bedded rooms? Do we have small surgical suites? Do we have dead-end corridors? Do we have spaces that are dangerous from a life safety point of view? Are there structural deficiencies? Are the columns spaced far enough apart for modern needs? That's frequently a problem in many of our hospitals, especially in big cities. Can we measure the energy savings of the proposed project? This is the hospital's big chance to do something that's going to last many years in the future, and it's so very important that they get it right this time around. Has a cost-benefit analysis or any other kind of studies been done for the proposed project? Share them with us, please. And most of all, we're going to have an OAE project manager, and we're going to have the OAE staff person come out if necessary. So they're going to have to walk the sites and get in everywhere and take a look around. Has the hospital made any enhancements over the last few years? Frequently, hospitals grow in spurts. Please explain to us what has been done. Are there photographs available for the existing facility? We frequently check out databases to verify environmental issues related to specific sites. Has the database changed in the last couple of years? Does the floodplain relate to the hospital, or is there a new floodplain map as so many areas are revising their floodplains? Do we have the latest information, or are we mistaken? Are there any above ground or underground storage tanks, either on the site or immediately adjacent to the site? All these things are part of that 4128, and we really have to know whether they pose a problem. And the sooner we get involved, the better off we are, because if we have a problem, sometimes it may take a long time to resolve the matter and maybe even kill the project. So you should know this. It's sad to say, but you know, if it's going to kill the project, you're better off knowing it right off the bat than wasting a lot of your time, our time, and your client's time, unfortunately. Are there any outstanding environmental conditions from old issues that need to be processed on the existing hospital site? We're going to have a licensed architect or engineer for the proposed work, I assume. And will a building permit be required for the proposed work? We assume there will be a need for that. And what is the outcome of the 4128? Will there be conditions in your commitments? Will the building permit be required for the proposed work? And I guess that about sums up what we're looking for. So we're going to do quite a bit when we go out there and kick those tires. That's what's in the back of our minds. So be prepared for that. You know, because you came to the training today, you have a sneak preview of this form. You're ahead of the game as opposed to other people who have yet to see this video on our website. But I just thought I'd share it with you, so you have some information from us. The next thing I've been asked to talk about is the new construction guide. OAE lives in Appendix 8 of the construction guide. Remember, 8 for OAE. Part 1 is an overview of the construction progress requirements. I'm on page 120. For those of you on the internet in the outer orbits, essentially Part 1 has been totally rewritten from 1973. Any of you have ever looked at that old construction guide? It didn't even relate to the program because it was so antiquated. And so what we did was we practically rewrote everything. And after 40 years, I think we've heard enough of the questions that have come up, so that we tried to address them in that guide. And so if you don't know what we do, and you have nothing better to do some evening, you can just check out Part 1. Part 2 is our ever-famous construction management guide. Those of you who have worked with us years ago know we used to have the green book, the red book, the apricot-colored book when we worked in HHS, and we used to give out hard copies to everybody. And then we changed over to the electronic versions, and we had 1 year a proposed interim guide, another year, and another guide, and another guide. If you can clean out your closets now, we had a design build guide that was only hard copy. You can chuck it all out, and you have one place to go now. As a matter of fact, I wish you would throw out all your old guides, because we have a tendency to get the old stuff that keeps coming back to us, and we'd appreciate it if you'd use the latest guide. Part 3 is the guide for design build services, which has greatly changed. For those of you who might have done some work on design build projects, we really have changed that section most of all. As a matter of fact, design build wasn't even in the handbook years ago. It's something new that we've incorporated into the program. As also Part 4, the environmental review requirements have been incorporated because our office never was involved in that portion of the work before. So now you've got one-stop shopping in Appendix 8 for OAE. The Part 1, if you follow me on the next slide, 121, is an overview of our construction process and requirements. Now, maybe you as mortgage bankers are not that interested in all of this, but I can assure you that your architects and engineers and your contractors and your owners' representatives and even some of the clients, the owners that you serve, they're very interested in knowing great details. And the architects, when they come into our office, when you give them a guide like this, they come in with a million questions and they interrogate us to death. So I hope that we've solved all of the questions by redoing the guide. But you know what happens when you write a guide, right? Somebody's always got something that they find that, you know, where you could come and improve the guide. So we're asking you, if you'd like us to improve the guide, or you don't understand something, we're here to work with you and explain things to you. And so we're always open to having discussions with you. So it explains all the different steps that we go through, all the different specific HUD requirements for the program. What we do for 242 is similar to what we do for 241, 223F, et cetera, et cetera, et cetera, pretty much. So that's about it. And now, we have the CM guide. It's pretty much the same. If those of you who have worked with us with the CM guide in the last few years, it's pretty much the same because it's been so popular. That's our most popular form of construction contract methodology. And for those of you who are unfamiliar with our guide, Part A in Exhibits 1 through 8, I'm on page 125 now. Parts A is the consultative phase for the construction manager, and Part B, which is a very important question that your clients are going to ask, where's your CM contract format? It's in Part B. That is our construction contract format, for those of you who are unfamiliar with our Part B contract. Perhaps the most important thing that has changed is the Part 3, the guide for project applicants for design build services. Years ago, we had a $30 million limit, then we went to $60 million. Now we don't have a dollar limit anymore for design build. We had to change the form that was used, form of contract. We used the American Institute of Architects form of contract because it's very popular with the industry. The one we had before is out of date. We can't Xerox AIA contracts because that's illegal. So now we have to go to what's current, and what's current is the AIA 141 2004 edition with its exhibits. It requires an owner's representative that's a licensed architect or engineer. And if the hospital doesn't, if the design build firm does not want to competitively bid out its subcontracts, then the hospital is forced to hire an independent cost estimator. But my experience has always been that the CMs want, the design builders always want to 100% bid out their contracts, but it gives them the option here. Now, because we're running short, I'm not going to go into all of the details here, but what's very important is the next page, 127, the addendum for design build. If this addendum is not incorporated into a design build contract, we will not approve it because this is tailored just for HUD. Design build is a very risky or riskier form of construction contract, and if we don't have what's included in this, we could have trouble, so it's required. And so everything else is pretty well explained here. For pre-commitment work, for site preparation work, we do have to have the environmental analysis done, even for 223F projects if you're going to have construction. And finally, the last part is the construction guide for environmental review and requirements. And I believe, I'm not going to go into all of this, but we will fill out the 4128 form. Your client's environmental consultant doesn't have to fill out the form. Just make sure they do a great job with the phase 1 and a phase 2 if that becomes necessary. Contact us early. Make sure that all environmental conditions are identified as soon as possible. That saves your time and money. And make sure that the environmental consultants that are hired are qualified because there's a certain requirement in ASTM for their qualifications. And if remediation has to be done, we'll work through that with you. And if the design has to be adapted to conform to certain environmental requirements, like if you have to beef up the windows because of noise or whatever, we make sure that is done when we review the drawings and specifications. So then finally, on the last page, I just want to tell you that because the environmental analysis gets involved with so many complicated words and acronyms, we have provided a glossary for acronyms at the end of Appendix 8. And with that, I'm glad to see so many new faces out here. My office is very excited about the new program, and we look forward to working with you in the future. Thank you.
Thank you, Teresa. Yeah, when you get into construction projects at hospitals, oh my Lord, the stuff that comes up. You wouldn't believe it. I mean, there's environmental, there's stuff buried under the ground you didn't know was there. Any number of things can really derail projects. But I'd like to move on if we could. What we have now is, my next speaker is Bert Marachi, and Bert is the Director of Portfolio Management for all of the hospitals within the portfolio here at HUD. And I think it's important for us to share with you, if we could, for a couple of minutes, some of the things that we've learned about some of the hospitals that we have in the portfolio, where we have great hospitals, what makes them great, when we have problematic issues, what those look like, what those causes might be, So in many respects, we're just trying to be transparent and share with you the good, the bad, the ugly, the things that trip us up, the things that you might need to be aware of as lenders when you look at hospitals, maybe things to be thinking about. And, you know, if you've got a transaction you're thinking about bringing us, maybe some of those problematic issues that HUD might really struggle with. So with that, Bert Barachi, Bert, come on up. Thank you.
Well, good afternoon, everyone, and welcome to Lender Training. It's gratifying to see some of the folks we've worked with in the past, and a special welcome to those new lenders. We look forward to establishing a mutual long-term relationship with you, our partners. Within portfolio management, among the many responsibilities that we work on, there was a special team put together many years ago called the Hospital Turnaround Team, with the single goal of preventing claims. That group has been successful, and working with you, we have prevented any claims within the last 2 years. Like any accomplishment, it's always a team effort. All of our AEs and account executives are involved not only in underwriting, but in asset management, and we rely heavily on our lenders to work with us with troubled hospitals. So yes, please take a bow, because it's truly a team effort. When we do run into troubled facilities, we try to learn from that. You've heard the term, we've said it before, lessons learned. What can we take away from that experience to make this program more effective? What has happened in either the underwriting or asset management that has not worked well? And how can we incorporate these lessons back into asset management, underwriting? Paul and I work as a team. Where there's new applications coming in that might be problematic, Paul gives me a heads up. We talk about it. I get involved in those. When I see things on the asset management side, I feed those back and say, hey, here's what's going on. Let's keep our eyes open for them. And we try to incorporate that. But what I'd like to share with you are some of the common characteristics and themes that we have found in some of our troubled facilities. Without equivocation, I can say for every claim that we've had an ineffective board. Moody's now ranks evaluation of the board and management as one of the most critical evaluation events that they do when they rank a hospital or health system. Taking a look at number 2 or number 3, when you have an effective board, management, and medical staff, you usually will have a well-run hospital that's achieving its goals in every way that you can measure it. Whether you want to look at return on investment, quality, community benefit, they all work very well. If one of those areas is out of sync, and we've seen it, you could have problems. And if it's, especially with the medical staff, many times they'll vote with their feet. And all of a sudden a facility that was doing well, all of a sudden is struggling because business has gone elsewhere. One of the items that I think some of our staff are probably getting sick of me saying is, do they have a strategic plan? Do they have a strategic plan? You know, if you don't have a strategic plan, where do you know you're going? We have facilities in the portfolio now that have plans going out 5, 10, 15 years. They are grasping the future and saying, here's where we want to be, here's how we're going to grow, despite all the cuts in reimbursement, the accountable care organizations, and what have you. What kind of medical staff do they need to recruit? Are they going to have an endowment of XYZ dollars to carry out their programs, knowing full well they're not going to get reimbursed? And more importantly, how about that board and management growth? How about growing more folks so they can replace them? Some of the other items on there I think are fairly straightforward. If you look at liquidity, how many days cash do you have on hand? And more importantly, is it decreasing over time? Are the bills going up? What does that mean? You could have, as we had in some of our facilities, they've started ventures, non-hospital ventures, or physician employment ventures that are losing money. Now, depending on how you define that, and there's ways to do that, the question is, when you take the entity as a whole, is it getting better or getting worse? And the very last one that's listed there is almost a gimme. If you see a lot of turnover, there's an issue. And in almost every event where we've had serious issues with a facility, there's at least been a turnover of one individual, either the CFO or the CFO. Why am I sharing these with you? For a number of reasons. First, as our partners, I'd like to share with you what our experience has been. Two, to also ask your help. When you see these kind of characteristics, either in underwriting or during the asset management phase or the life cycle of a facility, please bring it to our attention. We, as within the asset management group, if we see these sort of trends going on, we'll let you know about it. And together, if we get there early enough, we can usually prevent serious problems from happening. Thank you very much, and have a good day.
Well, I thought I'd just take a couple of minutes of our time this afternoon. We are running a little long, so I'm going to try and shorten a couple of the sections that we have, but I wanted to have myself and Paul and Catherine Glean from our risk management group just take a few minutes and tell you a little bit about what's kind of new and just give you some outlines of what our group is doing. So I think we're just going to grab a table over here. And I'll just grab my notes real quick. 1 second.
Can you hear me?
Okay. So you know Paul, and this is Catherine Colleen from Risk Management. So just an update for you folks. I wanted to just provide you a short update of some of the activities that we've been doing as a team, really. As I don't know whether you guys know it or not, but there's a lot of change going on within HUD itself. HUD is changing the way it does business, and so is the Office of Healthcare Programs. You know, I arrived in January and I took a look around and just tried to bring sort of the banker's mentality to the table to find out, you know, just what type of underwriting do we do, how is it being done, and we made a lot of improvements to that process over the past couple of months. So things are going absolutely a little bit better with underwriting and streamlining. Sorry, here come my nerves again. It's tough, but I'll try and get through that. So on the underwriting side, what we did was we streamlined our underwriting document by first taking a look at how the deals were being structured. It seemed like to me, at least a lot of the information was pretty voluminous. There was almost 50 pages of documentation when it came to an underwriting event. Now it's been sort of cut down to about 5 or 10 pages or so. It's a lot more efficient. In addition, we've sort of brought ourselves into what 232 has been doing, which is introducing the lien process to our shop. I don't know if any of you lenders have done work on the 232 side for assisted living and long-term care and skilled nursing, but they'd really dramatically improved the processing times for those types of transactions by instituting a lien process, and we're doing the same on the 242 side. So far, we're early into that process, but we anticipate streamlining our process and becoming faster and more efficient about how we process and receive applications, underwrite, approve, and put out commitments. So that's the goal on our side of the table. We're also working on gaining some new electronic platforms. Upon my arrival, I've noticed we have a lot of old legacy platforms inside HUD. 17 years old, some of these platforms. I'm surprised I don't see a C prompt when I turn the thing on. But coming from the banking side of the world, I know exactly what software is typically used by banks and financial institutions across America for doing financial statement analysis. And we're moving headlong into getting that type of platform installed here at HUD. There are challenges. I am dealing with the US government to get approvals to get software, and there's a lot of nuances to that, but be that as it may, again, it's another one of the changes that we're making within our group. We're also working on a pre-application tool that I think you, the lenders, are going to like a lot. It's not ready to be released to you just yet, and it's It's an outflow from our work with Lean. What we're going to try and do is become far more transparent to you in terms of the problematic issues we see arising from applications that come into us. The goal will be to release to you and put on our website information that really tells you very specifically if you're in a red category, a yellow, or a green, on a variety, a host of information that some of it is financial, some of it is regulatory, some of it is statutory, some of it is just common sense, but generally, what we hope to achieve is to give you enough information that allows you to have a pretty good sense that if you have a transaction and you work through the list, you'll have a very clear sense of whether this is a transaction that HUD is likely to approve. Not just meeting the basic regulatory and statutory requirements, but far deeper than that. We've also instituted a very deep partnership with our risk management group, and for that, I thought I'd have Catherine, come on up and give you just sort of an update of what her world does. In a way, for a banker's perspective, this is like credit department versus production department. So, Catherine, why don't you introduce yourself?
My name's Catherine Colleen. I'm the credit risk officer for the Office of Risk Management, and I'm working directly with OHF. I'd just like to give you a little bit of background on FHA and its commitment to risk management. I'm going to kind of go through these fast because I know we're short on time. FHA maintains a delicate balance, making sure that its insurance programs are sufficiently capitalized. It's balancing risk with the goal of achieving the FHA's mission objectives. One way they achieve this is through support of its risk culture. Okay, next slide. I'm not going to go through all of this. In summary, this slide describes the core risk management activities for ORM, which is the Office of Risk Management, which was started in 2010, so a relatively new department. In summary, we collaborate with each of the program offices. We define and develop risk management strategies, procedures, and governance policies. And this is done for all FHA programs, single family, multifamily, and in healthcare, we do this for both the 232 and 242 side. In addition to meeting regulatory compliance, we promote a risk-conscious climate in a manner consistent with FHA's missions and vision. Okay. All right. The governance principles. Key takeaway on this is it's a collaborative effort between risk management and all the program offices, in this case, OHF. We work closely with the hospital group to identify trends and issues that are then incorporated into business policies and procedures. But to be clear, OHF owns the underwriting and asset management business decisions. We're not the business owner, even though we have a significant role in providing insight and an independent view. In summary, it's a collaborative effort, with us being brought in early in the process. And this is in both the underwriting, pre-app, any kind of procedures that are being developed. We see it as a collaborative effort to try to work together. Okay. Okay. Taking risk is part of being in business. Risk management is not about avoiding risk. It's about understanding and managing the risk, as well as identifying your upside and downside, especially those associated with tail risk. Successful risk management allows for better business decisions and processes, not bureaucracy. So you can see the definition of tail risk up there, but all right. A successful risk program looks at credit, market, operational, and regulatory risk. Hospitals are facing some significant challenges right now, which is part of reviewing and managing the risk process. These include the Patient Protection and Affordable Care Act, increased consolidation and M&A activity, changes in state and municipal reimbursement, and also reviewing macro and micro economic risk specific to a hospital or region. Okay. Key to a successful risk culture is found in, oh, there it is, the circle. Showing continuous process being reviewed, refined, and updated. Main question, does the culture support the right mindsets and behaviors? For a risk culture to be successful, it needs support from the top, We have this in place, from the commissioners to the DAS of risk management and DAS and ADAS of the hospital group. This is in place. Sharing risk-related targets through collaboration. Again, this is in place right now. And involvement in the credit committee. And this includes bringing risk management in early to help facilitate a smooth and timely process. This is in place. We work with Jeff and Paul on the pre-app. I review feasibility studies, the CRTs. So we're brought in early so we can be part of the process to help facilitate and get it through. Okay, that's it.
Thank you. You know, I think what you're going to find when you talk with HUD on a go-forward basis is that you're going to really be talking to us really as bankers, you know, almost the same language you speak at this point. That culture, I think, is being ushered in by me primarily and by Catherine secondarily, and certainly I think Paul's had it his whole life, actually. But the tone of what we talk about, the way we think about the opportunities that you're looking at, I think we're kind of coming down the same pathway you are. So I think you'll find our conversations are going to be very much focused on, you know, who's the hospital, what's the loan size, what's the debt service coverage going to look like, you know, what's the need? Let's take a look at the parameters and see if it's going to fit within the regulatory and statutory constraints that we have. But we're going to be focused really on gaining speed and execution. I think those are the critical factors that I know the marketplace wants. You, the lenders, want it. The hospitals want it. We want it. I look at the program as one that's underutilized, and that it could be far greater than it is if we can simply become more efficient and move into a space that looks and walks and talks much more like a financial institution would, which is you see an opportunity, you get out in the street, you try and win that, you issue a term sheet, you win the deal, you underwrite, you book, you board, you disperse, you close. That's the tone I think belongs within HUD, and that's what I'm striving to achieve. And now, Paul, you came up as well. I know you had a couple of points that you wanted to make as well.
Yeah, just a couple of points. First of all, I wanted to thank both of you up here. I know, I think Roger Miller and Roger Lukoff might be the only ones who are more excited than I am about Jeff coming on. I think the changes he's begun to make already and that he's planning on making are great for the program and great for the industry. And, you know, over time, I think everyone's going to really enjoy you having you on board.
Thanks.
And with Catherine, you know, truly risk management is a value added at this point. You know, I appreciate all you're doing for underwriting side and helping us, particularly with, you know, what we're doing internally with the credit report that Jeff mentioned, and truly value added. What I wanted to talk about just very briefly, you know, there are a few natural sources of tension, I think, between HUD and the industry. And, you know, when we're doing what we're doing, we have a mission, of course, that you all agree with. But, you know, we're also very concerned, as Bert pointed out, with how well our loans perform. And, you know, we don't like having a single claim. You know, some of what we do reflects that, and it might not be apparent to everyone out in the industry. But as far as the natural sources of tension go, I think I divide it into three categories. There's the process, policy, reg, statute, interpretations, and then sort of the credit side. With the process, I know Jeff has a lot of good ideas about how to improve that. And over the last few years, we have made some improvements. I think the process is more smooth and predictable now than it was just a few years ago. That's not to say it can't be made more efficient. That's not to say it's still it's too long right now, I think. You know, and some of what we're doing, some of what we're planning now should help flexibility with pre-application meetings, allowing some accommodations with what level of financial feasibility study we require. These things should help with processing times and that sort of thing. And Jeff has more ideas that he'll implement, I think, pretty soon. So we really want to do better when it comes to processing times and making the process as smooth, predictable, and short as possible. Another source of tension, as I called it, I think policy interpretations, statute reg, I think 2 of them were on full display this afternoon with cash equity requirement for 241s and the other item. When issues like that come up, generally, and that's the case with the 2 issues that came up today, we have a good group of people who we bring together to discuss the issues. We always bring in legal. JB's often involved just because of his vast knowledge of the program. I'm involved, Jeff's involved. And we do our best to come up with what we think is a fair, equitable solution, all based on what's in the regulation, what's in the statute. And that's not to say we always get it right. I know that industry's going to send us some comments on the handbook, and we're happy to look at that, and we're very interested in what you guys think. We don't, on all these handbook items, there's 100 of them in the handbook, and each of them required thought and discussion internally, but that's not to say we got everything right, and that's not to say that we're not willing to rethink some of it. So we look forward to hearing comments on the handbook. Last, with the credit risk tolerance, risk tolerance is always going to be a subject of tension, I think, between HUD and the industry, what sorts of deals we're willing to do, what an acceptable level of risk for HUD is. I think, please understand that, as Bert said, there are lessons learned in underwriting and in asset management, and those feed back into what we do, and it affects what our risk tolerance is. So a deal that was done, 2 years ago or even 6 months ago, may not be doable today because of what we've learned on the asset management side, on the underwriting side. But understanding that we're always going to have different ideas about what sort of risk tolerance HUD should have. One thing we do know that we need to do better, and Jeff touched on this, is communicating what our parameters are. A good example would be like, how low can a day's cash on hand ratio go before we're, getting heartburn about it. And that's what we're doing as part of the lean process. So I think in the future, we'll be able to better communicate what the industry has been asking for a long time, and that's what sort of deals is HUD willing to do, what do we want to see. I think under Jeff's leadership and with my help a little bit and Catherine's help, we'll be able to get much closer to that.
Yeah, thanks, Paul. The long and the short of it is, listen, if there's a transaction and you're looking at it, we're bankers and finance people, and so are you. I mean, if you look at it and go, wow, that's a pretty sketchy deal, chances are we're going to think about the same about it as well. So I would encourage you to go out into the marketplace and, listen, we're going to do our part to make sure that the program is more attractive for hospitals to use. I mean, I understand you're almost the sales force of the product that's here, and when you speak with hospitals, they sometimes have a natural proclivity to say, oh, the HUD highway, don't make me go down the HUD highway. And we know that, okay? And my goal really is to make sure the platform and my speed and accuracy are built here so that when we say we can deliver something for you very quickly, very efficiently, and repeat that over and over and over, that you'll be able to trust that we can do it. So that's my commitment to you. With that, we're going to open up the question and answer session. We have a hard stop at 4 o'clock for our broadcast, so we do have to press on to do that. So at this point, we're going to open it up for questions. And if I could have some of the folks that we're presenting today come up and join us. I think JB and a few others might. If we have questions, please, would you just go right to the microphones here, and we'll see if we can't address any of that. Here comes JB. Okay. Who else do we have up for Q&A? Kelly, would you come up for a minute? Sorry, Kelly. Kelly's like, no. And our first question. Hi.
Hi.
Hi. How
'Cause
are
I'm
you?
shy.
I see Wells Fargo. Is our mic on?
Not.
Okay.
One that's just a point. On construction transactions where you make the comment that all equity has to go in before any debt, if we do a Ginnie Mae taxable transaction, it's really important that you let us do a $50,000 component to lock in the Ginnie Mae rate because we have a delivery of that first security early. So we just need you to accommodate a small, I think it's 50,000 piece of mortgage on the first draw so that we can lock in the Ginnie Mae investor. We have to deliver that first Ginnie Mae CLC by a date certain, and they pay extension fees until we hit it. So what we do in the other programs is if it's $1 million first draw, we'll do a $50,000 Ginnie Mae, and the rest is equity until it's used up.
Okay.
So just a point for you to be aware of. That's important.
Yeah, I'm wondering, who would be best able to address a Ginnie Mae question? Because, point noted, and
Well,
I'd like to talk to you offline a little bit more about how that works.
You'll kill us on the interest rate. It'll be a forward commitment if we
Sure,
can't do
sure.
that.
No, if there's a good idea, we're
Yeah.
willing to listen to it.
Okay.
Absolutely.
And then my other question was more of a threshold question on the 223F. You make the comment that any debt associated with a construction project has to be at least 2 years old. Is there a threshold, like I replaced my roofs last year and it wasn't that much? Or is that any debt?
Please, yeah, go ahead.
Yeah, I think it's either in the reg or it's in the handbook. I think the handbook that kind of talks about, we're not looking at, minor repairs that every hospital is always doing construction. We're talking about actual structures.
Brick and mortar.
Yeah, actual big structures that are
Okay.
constructed and not, the roof replacement or, the things that happen in hospitals continually.
Okay, so if you have debt associated with a small project, that can be paid off through a 223F.
Right, I believe so.
Thanks.
Okay. Next question. Others? I know we also got some questions online. We'll get to those in a minute, but I'd first like to do the ones in the room here, if we could. Yeah, step right up. Your name, please?
Oh, Priscilla Harrell from Brocadia.
From Brocadia. Hello.
I have a question about the refinance, 242 refinance program, where there's 20% construction piece to it. In the way that I read the new handbook, it appears that you have the option of doing some form of draw on that 20%. Does that mean we would treat the refinance F almost like an initial endorsement, do draws on that 20%, and then do a final endorsement? It wasn't very clear how that 20% construction piece worked in the process.
Yeah.
Well, it's actually, just so we're clear, it's less than 20% for 223F. And it can be set up if it's a big enough project, but still meeting that threshold. I think it can be set up as an initial final, but I'm not necessarily sure that's the way most of them will be done.
Yeah, most of them will just be done as a single endorsement.
Thank you.
Yeah, but you actually have a place on the form where you could check off if the project was substantial enough and was going to take long enough time that you could apply for insurance upon advances. But in most cases, we would anticipate there will be insurance upon completion.
Thank you.
Okay, sure, you're welcome. Others? Yeah, step right up.
Hi, Nick Nicholson from Kane Brothers. Is eligible debt, does that include, we said it included debt that arose from an acquisition, and I just want to be sure, is that subject to the 2-year rule also? I mean, we're looking at a fair number of Fs right now, and some of the hospitals have been bought recently. We're working with some for-profits, and we have yet to determine when they bought them. We'll get to that, but I want to be sure if that definition of eligible capital debt includes debt that arose from acquisitions, and then if that's indeed subject to the 2-year rule.
I'm sorry, John, could you come up and grab a mic so we can all hear you?
Right, I understand. Yep. Okay. Well, then, following on that, is I know 232, we recently got the ruling that when we do a 223F and subsequently we do a 241, the 241 is not subject, doesn't bring with it Davis-Bacon requirements, but I think I heard earlier that we would be subject to that here. Is that not? I hope I misheard that.
But for 223F, there is no Davis-Bacon requirement because you're below that construction threshold.
Right, but a subsequent 241 on top of the F let's say 3 years down the road, would that,
241 is absolutely subject to Davis-Bacon. Is that your question? I'm confused.
Under 232 in the housing, it's not, but 242, the way the regs are, you are.
oh, okay, so that's the difference between, okay,
Right, because we look at 241 as typically a construction project.
right, okay.
Bill Mulligan with Ziegler. I was questioning on your 7 criteria. One of them is debt service as a percent of revenue, and you picked the 3.4%. I was just curious of the benchmark. I mean, why 3.4 versus 4 versus less than that? I was curious about the benchmark of 3.4.
It was based on an analysis of the portfolio at the time. I think that was a median of all the portfolio hospitals. So we didn't pick it out of thin air, thankfully, but it was based on the portfolio.
Matt Andrea from Love Funding again. For 223F. Thank you, got me. For 223F, there's a lot of detailed guidance about how it plays out in refinance transactions. But of course, the statute and the regulations say that it's also eligible to be used in purchase transactions. And I just wonder if you could address your thinking, even if it hasn't all been, finalized or crystallized, is how it can be used to support a purchase. Given the fact that, if a hospital purchase opportunity becomes available, the purchaser has to generally move, fairly quickly to execute their purchase. But given, the possibility of, say, a 120-day review process or even a 90-day review process, that might not always work. So I guess the first question is, could the purchaser take out a bridge loan, and then could that be refinanced? And that would be treated as a refinance rather than a purchase. Then the second question would be on, in a number of for-profit hospital situations, the hospital operator is actually leasing the hospital, but built into the lease may be a provision that at a certain point in time and based on certain formulas, they can acquire the hospital. So the first question there is, would that be regarded as an arm's length transaction since they already have a lease relationship with the actual owner? And but second, if there's a formula built into their lease, would that be, for determining the purchase price, would that be recognized by HUD as a legitimate purchase price?
Well, you've exceeded the limit on questions for the day. Very sorry. In a general sense, I'll try and address some of your points, and guys, please jump in with your thoughts as well. With 223F, with regards to acquisition financing, we're in the infancy of the 223F, and in terms of acquisition financing, it probably needs some deeper scrutiny on our part to really understand exactly what areas we're comfortable with using it for that. Every acquisition finance transaction is highly dependent about who's buying it, what the terms are, what the cost is, how leveraged it's going to be, what the amortization period is going to be, how much equity they're putting into the transaction. All of those are real big underwriting questions, and I think they really drive an appetite level on our side to really understand, what's being purchased. Now, for an example, if you have a fairly sizable hospital system that wants to do sort of a HUD-endorsed transaction for picking up their 9th hospital and adding it to their system, that's probably a pretty strong transaction, right? There's a big parent involved with deep pockets and great cash flow. I think we feel pretty comfortable diving in and really working shoulder to shoulder with you to sort that out. But highly leveraged, thinly capitalized transactions between partners that are financially having very difficult times, stretch deals, story credits, call them what you like, those are going to be tougher for you as lenders and for us as mortgage insurers. So I don't know if anyone has any additional thoughts on what they think of how we're going to approach this, but that was my general thought when I first thought about acquisition financing. You know, we insure mortgages for hospitals. We are less M&A experts than mortgage insurance providers. So, you know, thoughts from the group?
Well, my thoughts were if there can be a construction project or hard costs and it's going to be less than 20%, go 223F. If it's going to be more than 20%, go 242.
Yep.
In there, with respect to that. In terms of when you got more detailed there, my thoughts were, boy, answering that on the fly without the actual facts and circumstances of the case, that gets really tough in here in terms of how to say. So I think we'd have to deal with that almost on a case-by-case basis, depending on the actual facts and circumstances. And I'd say call us early, don't call us late. So
No 11th hour calls.
I'll show my ignorance here. Matt asked me this question before, and I couldn't come up with a reason why we wouldn't be able to do, say, a bridge financing and then refinance that with the 223F. But I'll look at legal counsel and our policy expert in the front row here to see if they can come up with a reason why we wouldn't be able to do that.
Yeah, I think we should just take this
Okay.
offline at this point, because I don't want to say something that's incorrect.
I know we have some online questions we'd like to get to. Any more questions here from the floor before we get to some of our online questions? And can you read those out over there for us, folks? Let's see what we can see.
Sure.
What questions kind of came in.
Actually, we've got a couple related to bridge financing, so we'll have to revisit that quickly for those questioning. Also, here's one from Red Capital, questioning: an acquisition price will be based on a combination of income, capitalization, or multiple in sales comparables. Replacement cost will not be a factor in determining the purchase price, and such cost will usually be much, much lower than price paid / fair market value. An appraisal will support this. What value will be used in calculating LTV constraint in a 223F for acquisitions? Utilizing replacement cost rather than purchase price or fair market value will make 223F acquisition loans nearly impossible.
This program under statute is a replacement cost program, and because it's a replacement cost program, in calculating the loan to value, we are restricted to that. Now, they may pay more. You may pay more for work in place. You may pay more because there's accounts receivables that are part of the deal. There's all sorts of things, and that's going to end up being additional cash equity they're going to have to put in to play. But the handbook and the applicant's guide is very clear with respect to that. It's going to end up being the lower of the value or the cash price, and it's going to be limited to 90% of that.
Moving on, how does HUD look at a replacement hospital versus a new startup hospital? Are there main differences or similarities? Is a replacement hospital considered slightly less risky in the eyes of HUD?
We tend to look at replacement hospitals as hospitals that have an existing operation in a location on a campus, and that it's probably a very old facility, 40 years old, 35 years old, and it needs basically a substantial, if not complete, rebuild. From my perspective, the new hospital is built while the old hospital continues its operation, and then operations are segued over to the new facility, and the old facility is either mothballed, recycled into office space or storage. In my mind, that is a replacement hospital. Even if that hospital happens to be located maybe a 1/10 of a mile or 1/4 mile away or within a very reasonable close area, that to me is still a replacement hospital. I think when you talk about startup hospitals, you're talking about a hospital that has never existed in a particular footprint. You're talking about a hospital that will need to start from scratch. It will need Medicare and Medicaid provider numbers. It will need to hire doctors. It will need to get utilization from other providers in the community providing healthcare in the community currently. Those are my definitions of what a startup hospital would be versus what an existing replacement hospital would look like. And folks, I don't know if you disagree with those thoughts, but
I think simply based on the fact that we require an initial operating capital fund for a startup and don't require that for a replacement hospital necessarily, I think that reasons that we consider startups a little bit more of a risky proposition.
yeah, and it's true. I mean, you know, when it comes to a startup business of any nature, let's forget about hospitals for a second. If you're starting up a new company, you know, it's a risky endeavor. You know, a lot of companies fail, and venture capitalist companies are out there for a reason, because they take on these big risks of these startup companies that have huge startup risks, and there's no guarantee of success. Versus a replacement hospital that's got doctors and nurses and patient flow and years of, you know, history to it. The management team isn't changing. They're a very well-known group. So, yeah, the risks are very different, and I think all of us as lenders understand the differences between the two. What's our next question?
Is Teresa still here? They left. But we had a question asking if the checklist that she ran through for site visits would be made available, you know, in a kind of a more user-friendly format, and I'm sure that we can do that.
Yeah, sure we could. We're all about being transparent, and if there's an ask out there to put something up on our website, we're happy to do it. You know, as often as I can, I'd like to show everyone in the lending community just what we do, how we do it. The more information you have, the more knowledge you have about how we look at things here, the easier it will be for you to go, okay, they're going to look at this way, and if that's the case, then I have no reason to keep chasing this deal because it's not going to work. So it'll help you waste less time on transactions that won't work for you or for us. Then again, it'll also highlight the spaces and places that are probably best suited for transactions for both of us. So I'm here to help all of you try and get those deals done. Anything else, Nick?
Yeah, related to insurance requirements that we went through earlier. The question is, will OHF be requiring that existing hospital customers meet the requirements at policy renewal, or are those requirements in place for new loans only? For portfolio facilities.
And what insurance are we speaking of here specifically?
The property and casualty and malpractice insurance requirements for hospital applicants.
Why would you let that lapse?
Well, I don't think we can technically require any more than what's written in the covenants, but as lenders, I'm sure you could lean on your hospitals a little bit, and we might do so as well if we think we see a particular risk out there, but I don't know that we can forcefully require anything more than what's in the covenants of the handbook, or what do you think?
We can only do it in the context of they're asking us to make an exception.
The lender can, under the mortgage, I'm sure there's insurance requirements to keep the property insured in the mortgage, so it would be on the onus of the lender.
Yeah, the physical property is in the reg. So you do have, that's in there, and that's already required to be held. But in terms of the additional insurance requirements that have come out, that if the hospital's asking us to grant permission to do something, then at that point we could consider it, and it would depend on the facts and circumstances if we felt that it was warranted.
Okay, we're going to have to wrap up. I'd like to have Roger Lukoff come to the platform here, and thank you very much. I'm sorry,
Thank you guys. I just wanted to, on behalf of the Committee on Healthcare Finance, I just want to thank you for the work and for doing the handbook. It was very helpful, and will be more discussions. But I did want to make sure that somebody thanked you publicly.
Thank you, Rod. Thanks very much.
That was an excellent segue, Rod, because one of the things we're proud of here, and it's been established for many years with Roger Miller, is working with stakeholders, trying to get the best solutions. This is a program that's been in the National Housing Act since 1968, and we're ready to take it for another 50 years as well. couple closing remarks, and hopefully you can join us. We're going to meet at the Mandarin Oriental for a reception afterwards. But there are some common themes here throughout the day. There's been a lot of information. Obviously, please feel free to follow up with the individuals you heard from. Really great appreciation for Jeff pulling this together. Literally, the first day he got here, I said, by the way, this summer we need to have lender training on the F program, and I really think we accomplished getting the message across to the people here and to those of you online. What do we need to walk away with here? I know a lot of people here have worked with the 232 program, which we're very proud of, but the big difference is there is no queue for the F program in 242. And we look forward to really working with you so that you can move forward these applications in a timely basis. As a former healthcare executive, I can tell you one of the top 3 things on every hospital executive's mind is access to capital. This is a program that was approved so that, in fact, we can meet that need in the marketplace among the 5,500 hospitals throughout the country. The second piece here is essentially that the individuals you heard from today, I mean, the lines of communication are open. I mentioned Jeff, Paul, with his underwriting staff. Teresa had to hurry back, so she'll be in the office early tomorrow morning in New York, but they're there. The one person you really don't want to talk to, he did a terrific job today, but Bert Marachi is somebody who has to come in when there's a turnaround to take place. So we love Bert, but we want you to focus on the underwriting. We want you to be able to bring successful deals through the door, as Roger Miller likes to say. Finally, I have an advertisement because we focus on the hospitals. There's been a couple comments about working with healthcare systems, which Jeff just mentioned, are attractive to our portfolio, and we're working on ways to work with those healthcare systems. As a matter of fact, for those of you who watch our postings closely, yesterday we have posted a healthcare systems advisor for the Office of Healthcare Programs. And this is specifically somebody who can help us work with healthcare systems. So we're looking for people throughout the country. We are proud of the fact that we had a very successful national search to get Jeff to leave the beautiful state of Oregon. We'll hope to be successful with that search as well. Any ideas that you have, please let them know. There's a 2-week window right now for that particular posting. So thank you again, everybody. We hope to talk to you afterwards, but for those of you online, we're going to end right now, but thanks again.